Did you know that Morgan Properties, the third largest apartment owner in the United States, is set to expand its reach into Canada by acquiring Dream Residential REIT? This move not only signifies a substantial cross-border investment, but also highlights the growing interconnectedness of the North American real estate market. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In a significant development in the multifamily real estate sector, Morgan Properties, an apartment giant headquartered outside Philadelphia, has agreed to purchase Toronto-based Dream Residential REIT. This acquisition is valued at approximately 354 million United States dollars and marks the culmination of Dream Residential's strategic review. The Real Estate Investment Trust is set to provide its unit holders with a payout of $10.80 United States dollars per unit, which represents an 18% premium over the REIT's closing price last Wednesday. This deal is expected to close by the end of this year, pending stakeholder approval. Dream Residential REIT, based at 30 Adelaide East in downtown Toronto, boasts a portfolio of 15 properties encompassing roughly 3,300 units. These are primarily garden-style apartments located in metropolitan areas such as Dallas-Fort Worth, Oklahoma City, and Cincinnati. The REIT, which launched just 3 years ago, has been under the leadership of Chief Executive Officer Brian Pauls since June 2023. Morgan Properties, founded in 1985 by Mitchell Morgan and now helmed by co-presidents Jonathan and Jason Morgan, is expanding its already vast portfolio. With over 100,000 units across 22 states, this acquisition will further bolster their presence in the Midwest, an area where rent growth has been outpacing the rest of the United States, according to a report from CoStar Group's Apartments.com. This aligns with Morgan Properties' strategic focus on high-growth areas, including the Sunbelt and the Midwest. This acquisition also signifies the end of Dream Residential's service agreements with Dream Unlimited and Pauls Corporation, with a separation payment of $7 million United States dollars to cover outstanding fees and wind-down costs. This move by Morgan Properties underscores the dynamic nature of the multifamily real estate market and the opportunities that exist for cross-border investment and expansion. In the latest analysis by Oxford Economics, the Canadian multifamily real estate market is facing pressure from both an influx of new supply and ongoing trade tensions with the United States. The report reveals that the national average asking rent in Canada dropped by 3.3% year over year in May, reaching $2,129 per month. Notably, major cities like Calgary, Vancouver, and Toronto experienced the most significant declines in apartment rents over the past year. The surge in new multifamily unit completions, which increased by 35% in 2024, has contributed to this downward pressure on rents. Oxford Economics forecasts that this trend of strong rental supply growth will persist, as a record number of purpose-built rental units are currently under construction and will soon be integrated into the market. Oxford Economics also highlights a decrease in demand due to slower immigration and fewer temporary residents, which is likely to curb rental demand further. However, the report suggests that the challenges in home ownership affordability and the financial strain on households, exacerbated by the trade war-induced recession, will help maintain some level of demand for rentals in the coming quarters. On the international stage, the trade dispute between the United States and Canada has added another layer of complexity to the market. The tension arose when U.S. President Donald Trump threatened to escalate the trade war over tariffs unless Canada rescinded its digital service tax targeting American tech giants. While Canadian Prime Minister Mark Carney's administration agreed to resume negotiations, the uncertainty surrounding these talks continues to loom over the market. According to Tony Stillo, Director of Canadian Economics at Oxford Economics, unless a significant resolution is reached to alleviate the tariffs, the housing market slump is expected to persist through the end of 2025. Stillo anticipates that any potential recovery in the resale housing market will be hampered by poor affordability, weak consumer confidence, and job losses stemming from a likely recession. Despite these challenges, there is a silver lining. CoStar Market Analytics notes some rebalancing in the multifamily market, with vacancy rates in cities like Toronto and Vancouver approaching more balanced levels. This adjustment could provide opportunities for investors and developers looking to capitalize on more affordable urban markets in Ontario and beyond. As we look towards the year 2025, Canada is positioned at a pivotal moment across various fronts, including political, economic, and social issues like housing affordability and congestion. Despite these challenges, Canada remains a robust growth opportunity. According to CBRE's Real Estate Market Outlook for 2025, the country is expected to continue ranking among the top G7 nations in gross domestic product, population, and employment growth over the next 5 years, all of which are closely linked to demand for all types of commercial real estate. The year ahead is poised to see increased activity as the cost of capital crisis begins to ease. With global bond market conditions stabilizing, we can anticipate heightened investment and leasing activities. Although Canada has experienced a significant influx of new supply in the office, industrial, and residential sectors, leasing fundamentals are generally improving. However, it will take time to absorb this new supply. The economic outlook for Canada, while modestly lower due to immigration curbs, remains solid in the longer term compared to other G7 nations. This is favorable for commercial real estate demand. The capital market sentiment is improving, with stronger investment activity expected in 2025. There is a likelihood of modest compression in cap rates for some asset classes, contingent on global bond market conditions, as highlighted by CBRE research. In the debt markets, availability is expected to improve, though lenders will remain selective. Credit spread dynamics should begin to normalize, and loan underwriting will reflect broader market trends concerning rents and vacancy rates. The office sector is anticipated to shift towards a growth mindset, paving the way for recovery. This sector will see a bifurcation of products with a focus on flight to experience and a slowdown in new supply, leading to an undersupply of modern, amenitized, and environmentally sustainable buildings. In the retail sector, positive leasing intentions combined with a supply-constrained landscape will compel retailers to explore secondary markets and adapt the scale and format of their typical stores. The industrial sector, meanwhile, is dealing with softer demand and a surge in new supply, but is expected to work towards normalization sooner than anticipated. The multifamily sector is facing uncertainties in the near term due to immigration restrictions and new supply deliveries. However, the long-term growth fundamentals remain solid, presenting a compelling investment thesis, as CBRE points out. As we conclude today's episode, it's clear that while challenges exist, there are also significant opportunities on the horizon for multifamily real estate investors. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.